Have you ever really stopped to think about what money actually is? I mean, we use it every single day, but the story behind it is one of the most fascinating in all of human history. It's this incredible journey from something you could literally hold in your hand, like a shell, to a global system of pure trust that mostly just exists as numbers on a screen. Today, we're going to pull back the curtain and unravel that entire story. So, to get us started, I've got a little trivia question for you. What do you think is the single most successful, most widely used, and longest-lasting currency in the history of the world? And here's a hint. It's not gold, it wasn't the Roman denarius, and it's definitely not the US dollar. Any guesses?
The answer, believe it or not, is the cowrie shell. Yeah. For thousands of years, these little shells were the go-to form of money across huge parts of Africa, Europe, and Asia. And when you think about it, they were kind of the perfect currency for the time. They were naturally durable, they were almost impossible to counterfeit, and their supply was controlled by the ocean tides, which kept them just scarce enough to be valuable.
So, shells were a brilliant solution. But to really get why money was such a game changer, we first have to understand the huge problem it was designed to solve. We have to try and imagine a world without it, a world of just direct trade, barter.
The biggest headache with barter is something economists call the double coincidence of wants. It's a fancy term for a really simple problem. For a trade to happen, not only do I have to find someone who has what I want, but that person also has to want the exact thing I'm offering. Think about it. An accountant needs a new pair of shoes. She has to find a shoemaker who just so happens to need their taxes done. You can see how an entire economy based on that would just grind to a halt.
And this is where money enters the scene as a truly revolutionary piece of technology. It's such an elegant solution because it breaks that direct link. It completely solves that double coincidence of wants by creating one thing, one intermediate good that everyone in a society agrees has value and will accept as payment.
Now, for any type of money to actually work, it has to do 4 key jobs. First, it's got to be a medium of exchange, right? So our accountant can sell her services to anyone for money, and then use that money to buy shoes from anyone else. It also has to be a store of value, so the money she earns today is still worth something tomorrow. It needs to be a unit of account, giving us a common yardstick to measure the value of everything. And finally, it's a standard of deferred payment, which is just a way of saying it makes things like loans and future contracts even possible.
Now, for most of history, money was what we call commodity money. Things that had their own built-in value, like gold, silver, or even salt. In fact, the word salary comes from the Latin word for salt. But today, almost all of our money is fiat money. It has no value in itself. It's just paper or digital ones and zeros. Its value comes from 2 things: a government decree, that's the fiat, and most importantly, our collective trust and belief that it's worth something.
And this right here illustrates that change perfectly. On the left, you see an old US silver certificate. That note was literally a claim check. You could walk into a bank and trade it for a specific amount of actual physical silver. But the bill on the right, a modern dollar bill, is totally different. It isn't backed by anything you can touch, only by the full faith and credit of the system that created it. This quote really just gets right to the heart of it. The value of the dollars in your pocket, or the numbers in your bank account, is a shared story we all agree to believe in. It's an incredibly powerful social agreement, and honestly, it's the glue that holds our entire modern economy together.
Okay, so money solved the barter problem. Awesome. But as economies got bigger and more complex, a new problem popped up. How do you efficiently connect all the people who have savings with all the people who need to borrow money, say for a new business or a new home? Well, this is where banks step into the story.
At their most basic level, you can think of banks as financial intermediaries. They're the middlemen. They pull together the deposits from tons of savers and then channel that money to borrowers in the form of loans. It's way more efficient than trying to find one single person rich enough to give you a mortgage, right?
Now, to understand a bank's hidden superpower, we have to look at its basic scorecard, the balance sheet. It's actually a pretty simple idea. A bank's liabilities are everything it owes to other people. Your checking account deposit is a liability to the bank. Its assets are everything it owns, or what other people owe to it, like all the loans it's made. That difference is absolutely key.
And that brings us to the most surprising, kind of mind-blowing part of this whole system. Banks don't just move money around. They aren't just middlemen. Through the simple, everyday process of making loans, banks actually create new money out of thin air.
This incredible power is possible because of a system called fractional reserve banking. The rules say that when you deposit money in your bank, the bank doesn't have to just let it sit there in a vault. It only has to hold on to a fraction of it, a certain percentage, which is called the reserve. Everything else, it's free to lend out.
So let's just watch how this creates a ripple effect. Let's say you deposit $1,000 into Bank A. The bank keeps 10%, that's $100, in reserve, and it loans out the other $900. Now, the person who borrowed that money spends it, and whoever they paid deposits that $900 into Bank B. Okay, now Bank B keeps 10% of that, $90, and loans out the other $810. That loan gets spent, it gets deposited again, and this cycle just keeps going and going, creating new money at every single step.
This powerful cascading effect has a name. It's called the money multiplier, and yet there's even a simple formula to figure out its maximum potential power. You just take the number 1 and divide it by the reserve ratio. So in our little example, that's 1 divided by 10%, or 0.1, which gives us a potential multiplier of 10.
And here is the jaw-dropping result. That single initial deposit of $1,000, as it gets loaned and redeposited all the way through the banking system, can end up creating up to $10,000 in the total money supply. The original $1,000 is still there, but the process of lending has magicked $9,000 more dollars into existence. It feels like magic, but it's really just the math of modern banking.
Now, a system that can multiply money like this, well, it obviously has enormous potential for good, but you can imagine it also comes with some serious risks. A system this powerful needs a referee, someone to set the rules and manage the game. In the US, and in pretty much every country, that job belongs to a central bank.
Here in the States, that's the Federal Reserve, whereas everyone just calls it the Fed. It's the institution that sits at the very top of the whole banking pyramid, watching over everything. Remember that reserve requirement we talked about? The rule that makes the whole money multiplier work? The Fed is the one who sets that rule. The Fed really has 3 main jobs. It conducts monetary policy. That means it manages interest rates and the money supply to try and keep the economy stable and growing. It also acts as a bank for the banks and for the government itself. And maybe most importantly, its job is to promote the stability of the entire financial system, to basically try and harness all the power of banking while keeping its risks in check.
And that, right there, is the fundamental trade-off of modern finance. This system of fiat money and fractional reserve banking is an engine for incredible economic growth. But the very same process that creates that growth also creates huge systemic risk. When it works well, it fuels prosperity. But when it's mismanaged, as we all saw back in 2008, it can lead to some absolutely devastating crises. It's an unbelievably powerful tool that has to be handled with extreme care.
Which brings us right up to the present moment, to the edge of the future. We've traced money's journey from physical shells all the way to a system based on trust in big central institutions. But today, money is changing again, evolving into decentralized digital currencies like crypto that challenge that whole model. And it leaves us with a really profound question. As money shifts again, who's going to write the next set of rules? And what will trust even mean?